U.S. President-elect Donald Trump reportedly invites Chinese President Xi Jinping to his inauguration, despite fresh tariff threats against Beijing. Now, traders cement bets of a Fed cut next week after inflation rises in line with expectations. Plus, the ECB is set to cut rates for the fourth time this year, loosening constraints on the region's struggling economy. The Swiss National Bank surprises with a half-point cut. Now, also on the show, we discuss the economic outlook for the U.S. and China with Jim Bianco, president of Bianco Research, and Michelin star chef Jason Atherton joins us to discuss his latest restaurant on Savile Row here in London and the future of hospitality. But first thing is first, let's take a look at the European markets map. A lot of the focus, of course, is on Swiss franc. So we're seeing, look, equities is always good to look at, but it's not really where a lot of the volatility is playing out. If you zone in, so you have the FTSE gaining 0.2%, similar gains for the FTSE maybe in Italy, but it's really Switzerland, which at the moment is gaining 0.6%, where we need to look at the Swiss franc. Now, first, this is the first major decision, the biggest easing in this cycle by the new president, and this was probably a way of defending the franc that has also been used in the more traditional way of actually, a bet against inflation, but also a safe haven against some of the geopolitics concerns. So now you can see the Swiss franc there, 0.9328 compared to the euro. S&P future is practically unchanged, and then the U.S. 10-year yield at 4.2906. So for the conversations that matter, there's quite a lot going on. But first, we also have OPEC Plus from the IEA. So the IEA has come out with their report. OPEC Plus supply delay will not prevent an oil glut next year. So let's look at what kind of impact these reports usually have on the price of oil. Brent and WTI gaining some 0.5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, despite the threat of stiffer tariffs on China, U.S. President-elect Donald Trump has reportedly invited Xi Jinping to his inauguration in Washington, D.C. next year. Now, we'll get more market analysis from Iain Stealey from JPMorgan Asset Management in a moment. But first, let's speak to Roz Matheson, Bloomberg's EMEA News Director. First of all, Roz, thank you for joining us, as always. I saw the headline, and I kind of thought, oh, he's back. I mean, this is how it's going to be. We're going to have, policies unexpected come up that are actually very significant. What do you read into this?
Well, it's interesting to see the report, as you say, that Donald Trump was going to invite Xi Jinping to his inauguration, because heads of state tend to not go to presidential inaugurations in the US, and certainly a Chinese leader does not. They tend to send the ambassador. So maybe the invitation has come, but would Xi Jinping go is the big question. And the feeling seems to be unlikely to do so. I mean, for a start, sitting outside in the cold in January in Washington for several hours, a la Bernie Sanders with his gloves. But also, do you want to be in that audience not knowing, as you say, to the unpredictability of Donald Trump? What does Donald Trump say in the minute? Well, you're sitting there as the Chinese president. Perhaps he starts riffing on the Chinese economy or tariffs or something. You just don't know what he might say or do in that moment. And then how do you respond as the Chinese president sitting there? How do you react? So it's politically risky to do so. So even if the invite comes, he'd be unlikely to attend. But what it does show is that there are some ways that perhaps the administration of Donald Trump, despite the threat of tariffs on China and other countries as well, and to continue to penalise China economically, there might be a way that he's looking to have some kind of dialogue.
Yeah, I was going to ask you, so the last time they met was 2019, but also, he's basically trying to China bash on tariffs, but at the same time making him friendly. So there are a lot of people say that we're not going to get the tariffs that Donald Trump says because he wants a deal. Does this point towards that, or is it too early to say?
Well, China, like other countries, is pretty astute at reading the room. Again, on tariffs, we can see Donald Trump using that as a negotiating tactic, a political tool with Canada and Mexico. So he wants something from these places. And what can you deliver that kind of allows Trump to claim a win. Trump can say, I got this from you, therefore I don't need to hit you so hard on tariffs. And we know that Xi Jinping and Donald Trump, they have met before, and they've had kind of a bit of a rapport. They seem to admire each other in different ways. You know, they've had quite warm interactions when it's in person, and Xi Jinping will probably be hoping that maybe if they can meet together at some point before too long, he can have success in that regard again. So you're going to have probably a multifaceted relationship between China and the US, not just as simple as hitting each other on trade.
Ros, thank you so much. As always, Ros Matheson there, Bloomberg's EMEA News Director. Now, it's Stock Markets with Iain Stealey, International Chief Investment Officer for Fixed Income at JPMorgan Asset Management. Iain, I mean, we have to talk, of course, about the U.S. We have a lot to talk about Swiss franc. But going back to China, there's also a bit of a boost in some of the Chinese consumption markets because there's expectation of more stimulus, fiscal stimulus, monetary stimulus coming in the next couple of days. How do you play China?
I think it's quite challenging because ultimately, if you hadn't had the election, and if you saw everything that was going on at the moment, you would probably be quite excited about the opportunities in China. There's obviously, we do seem to have had a bit of a step change over there. Maybe it was a bit more piecemeal on the policy front earlier this year. Now getting a bit more concrete, really pushing that. But obviously, as you've just rightly pointed out, we don't know what's going to happen next year when it comes to tariffs and the relationship between the US and China, which does make it a little bit more challenging. I think what we're looking at is that even though Chinese government bond yields still look low, it seems an environment where they're going to stay low. So for me as a fixed income investor and sort of looking at global portfolios, you probably still actually want to, even at these low levels, own some Chinese government bonds. OK,
what do you do with US government bonds? Again, we had the inflation print. Does this change everything at once Donald Trump's in charge? So is it very difficult to read what kind of economy the US will be left with?
So, again, if you looked at the fundamental data today, it does now look like the Fed is going to be cutting rates again
December
next week. But I think the question mark is going to be more around, firstly, the dot plots and what does the committee think they're going to do next year, and then, of course, the press conference. And obviously there's going to be a lot of questions to Jerome Powell at exactly what it means. And the problem is he just doesn't know. And he doesn't know what the sequencing of the events is going to be. He doesn't know how, what the size of the tariffs are going to be, how much fiscal is going to come. So, in a sense, they really just do need to look at the data today. And the inflation data, maybe it's ticked up a little bit over the near term, but I think they'll take comfort from yesterday's shelter. Owners' equivalent rent components, which that was the area they were concerned about. That seems to be coming down. They still have some issues around softness in the jobs market. If I was them, I think this is the time, though, to set up the pause and let's see what happens over the next couple of months.
So what does it mean for Treasuries?
It means for Treasuries is you probably still want to have Treasuries in your portfolio because it's really an insurance. So, yes, there is possibility of big fiscal spending, but when you think about where Treasury yields are versus what could happen if things slowed down, we know they could go a lot lower if there was a problem in the economy and the Fed did need to react. And then really to get Treasury yields a lot higher from here, you probably need to be talking about the Fed hiking rates next year. And that, again, seems a long way off. So I think we're probably range-bound for now. I think there's other opportunities in other parts of the fixed income market. But actually just having some Treasury duration as portfolio insurance, I think that makes a lot of sense at the moment.
Iain, there's a lot going on with franc. I mean, this is a big market move. What is this? Is this beginning of a trade war? Because actually, the new president wanted to show that he's firmly in charge, and actually he's not happy with the level of the Swiss franc, or is it just a mechanism of the same thing?
I think if you look at the Swiss economy, it's slowing. Inflation is low. I mean, in a sense, they've victim of their own sort of issues. They have a very limited number of meetings throughout the year. Do you want to get in front of the curve now rather than try and play catch-up? And I think that's a question that is probably going to ask to Christine Lagarde later as well for the ECB. Obviously, the Swiss National Bank have got ahead of her in that sense. So I think it's more around actually just looking at their own economy and thinking about what they need to do to ensure that they don't continue to slow.
I mean, do you not think that they want to try and break the cycle of actually the Swiss franc really seeing as a haven, given all the geopolitical concerns?
Possibly, and I think that's one of the problems. I mean, the Swiss franc versus euro has been relatively strong over the course of this year. So that is something. But look at the inflation prints in Switzerland. You look at the economic data. It warrants them moving lower.
Okay, and we'll talk a lot more about the European Central Bank shortly. Iain Stealey, International Chief Investment Officer for Fixed Income at JPMorgan Asset Management, stays with us. Coming up, the ECB set to lower rates for the fourth time this year. Bloomberg Economics sees cuts at every meeting through to March next year. We'll be live in Frankfurt next, and this is Bloomberg. Now, the European Central Bank is holding its final policy meeting of the year today and is widely expected to deliver its fourth rate cut of 2024. Well, Lizzie Burden joins us now from Frankfurt for a preview. Lizzie, set us up for the decision.
Well, consider the risks, Francine, that have emerged since the last ECB meeting in Slovenia. You've got the collapsed governments in France and Germany, Donald Trump re-elected to the White House, and the threat of tariffs very much leaving the euro area in the firing line. But none of that really is expected to actually induce a 50 basis point cut today. Only JPMorgan, of the economists we surveyed, sees that happening today. But what it could do is encourage a dovish tilt in the language, in the statement. Specifically, they might remove this line that says they'll keep policy rates sufficiently restrictive for as long as possible. What it could also do is really muddy the forecast. We'll get an update on those today out to 2027. I'd expect them, therefore, to lean more on scenarios rather than a base case. And you could see downgrades for growth and inflation. We remember those PMIs in November. We remember Christine Lagarde at the last press conference saying that the inflation risks were tilted to the downside. Maybe we see that actually in the language of the statement this time. Further out, the debate really is about where neutral lies and whether to go below it and how much to go below it. Economists reckon 2% is where rates will settle. Traders reckon 1.75%. But this all comes down to really the limits of monetary policy. How much can interest rate cuts do about the big problems highlighted by Mario Draghi? Poor productivity, a shortage of skilled workers, the lack of financial integration. The likes of Isabel Schnabel, the hawks on the governing council, therefore make the argument that they need to stop the cuts sooner because there's not much that rates can actually do.
Lizzie, thank you so much. Lizzie Burden there with the very latest from, of course, ECB headquarters in Frankfurt. And we'll have live coverage of the ECB decision, a news conference starting at 1:15 p.m. UK time. Now, let's get back to Iain Stealey from JPMorgan Asset Management. Iain, I mean, again, it's going to have to be a skillful press conference trying to, you know, it's like walking a tightrope. It's basically not saying too much about what U.S. policies could look like, knowing that they could change the European economy completely.
Yeah, no, I think so. And I mean, there's a couple of things that I'm specifically looking for, because it does feel like they're going to go 25 basis points. I would like to see how they deal with the language about keeping policy restrictive. I mean, I think, obviously, the more recent evidence is that inflation is coming down. Is it more seasonal at this time of year? You know, how will it look in the first quarter? I think there's questions around that. But when, you know, as Lizzie said, when you look at the PMIs, when you look at the data, you know, Europe's in a tough spot. So is policy restrictive? But if you sort of take that out and too quickly, you know, why aren't they going 50 basis points will be a legitimate question. And then the next question for Lagarde, which I'm sure will come up during the press conference, is did they discuss 50? Yeah. And ultimately, you know, how many people felt that 50 was the right sort of move? So I think it will be an interesting to see how dovish the message is.
But they're worried about services inflation. They're also worried about wage negotiations that start in January.
They are, but actually when you look at some of the wage negotiations, and if you look at the negotiations that happened relative to sort of 2021, the new negotiations, yes, they were high, but actually if you look at the new negotiations that were more recently done, say 22, 23, they're not as high. So it does look like the wage negotiations are coming down as inflation is rolling over. And then you just look at the underlying economy and it does look soft, and I think that will be the bigger concern. Obviously, it is a more challenging, you know, getting everyone on board, getting all 20 countries on board to be more aggressive is going to be a challenge. But I think it's going to be 25 today, and then what is the trajectory? That's what the market will be focusing on.
Iain, a couple of other things. I mean, when you look at political France, it's a mess. We still don't have a prime minister. Maybe we get something by today. Germany is also going through a very uncertain election. How do you play fixed income in Europe?
So I think actually you sort of park
Stay away.
France. No, not Europe in general. Actually, if you think about it, what's happening, and you see the softness in Europe, actually European duration does make sense. But you look at the countries where you're more constructive on the fundamentals. So areas like Spain, areas like Italy get a bit more carry in Italy. You know, Spain's now trading through France, but you'd argue it's a better credit at the moment. I think that's how you play the European story. But actually, when you think about what's happening in Europe relative to, say, other parts of the developed markets, the argument for owning European duration makes a lot of sense.
All right, Iain, thanks so much, as always, for joining us. Iain Stealey there from JPMorgan Asset Management. Coming up, U.S. inflation remains above the Fed's target of 2%, but of course investors think it will not stop the U.S. Central Bank from cutting next week. We discuss all of that with Jim Bianco, president of Bianco Research. That's next, and this is Bloomberg. Welcome back, everybody. Now, investors still widely expect the Fed to cut borrowing costs by a 1/4 percentage point next week after the latest CPI figures rose in line with expectations. Well, I couldn't be more happy to discuss all of this with Jim Bianco, president of Bianco Research. Jim, I have a million questions on crypto, on treasuries, on everything in between. But what are the charts that you're looking at to see what equities do next?
I think it's going to be pretty much inflation and interest rates. The equity market is basically benefiting from stable to low interest rates right now. If interest rates were to start up, I think that could pose a headwind for it. And for what's driving that is the inflation data. And the inflation data came out yesterday, and it wasn't bad enough to stop the Fed from cutting rates. So it looks like we're on board for a rate cut next week.
Okay, so this is one of the charts that we picked out that you sent through, and it basically shows America's stock market worth twice its GDP. I guess, is there a Trump trade? Has that already largely been done because it's underestimating inflationary pressures, or does it unlock animal spirits?
No, I think the animal spirits have been unlocked. And what the chart shows is that the U.S. stock market is richly valued, or maybe even fully valued at this point. I don't know if you want to say overvalued. And historically, valuation is an important tool, not because it's a timing tool. The market could go up a lot next year, but it tells you that over the next several years, if you're buying an overvalued market, you should expect lower returns. And a lot of the metrics that you look at when to try and measure the lower returns, you might be looking at a stock market that could be returning you 6 or 7% in the next decade or so. But people are used to 20%, and that's a problem right now.
Look at that. I mean, that's the charts. What about when you look at a lot of the onshoring that's been happening? Does that change under Donald Trump, or are we going to see more volatility?
No, I think that, as far as when Trump comes in, the concern you would have is that you're going to see stimulus. You're going to see extension of tax cuts. Yep. You're going to see deregulation. You're going to see an economy. The U.S. economy has been growing quite strongly. That's going to get extra stimulus from a Trump administration. Not to mention that you might see some form of tariffs, and we all debate on how much and where, that could be inflationary. That is going to make a very strong nominal growth economy. The concern has always been, why is the Fed cutting rates in this environment? It doesn't need it. And the concern is all they're doing is fostering a more higher expected inflation.
Yeah, so on tariffs, how and when? I mean, look, overnight, CBS was reporting that actually Donald Trump invited Xi Jinping to his inauguration. I'm not sure quite how to take that. Is that means that, I want to negotiate, so hold on for the tariffs? Or is it just psychological kind of, wargaming?
That is the $64,000 question in the United States. What is his plan? Is it gambit? Is it that tariffs are leveraged to get something else? Or does he just want tariffs? I'm in the camp that it's leverage, that he wants to threaten tariffs as a punishment for not giving him a deal on something else somewhere down the line. Ultimately, we'll get deals and we'll get less tariffs. Others make a reasonable argument that, no, we'll get less deals and more tariffs. That's going to be the big question. Inviting Xi, I think, to the inauguration, I think puts it more in the deal camp, that he wants to talk and he wants to cut a deal with them.
So the other bit, I mean, markets are really trying to figure out passive versus active. And then you overlay like all the credit and the private markets that are flying through the roof. This is another chart that you picked, and it's basically, showing that's tougher for passive to beat some of the active bonds. Let's bring up the charts, and you tell me what it means going forward.
So what it tells you is, in the table, is that 90% of equity managers cannot beat an index over, say, 3 or 5 years. That is what we all know, and that is not controversial. But in fixed income land, it's a much different metric. It's more like 50-50. So active managers in fixed income just going into the game have about a 50% chance of beating an index. And the argument that has been made now that bond yields are 5%, and as I said, maybe stocks are going to return you 6 or 7 with a little more volatility, that bonds are in the game. The best strategy is a passive approach with equities and an active approach with fixed income.
Yeah, where do you buy in fixed income?
Well, that's the that's the professional.
Right.
Yeah. The professional manager would do it in there. Right. But I mean, where do you buy in fixed income? I like mortgages. I'm not so keen on corporate bonds. I'm a little bit defensive on interest rates because I think that they could go higher. But remember, even if you're defensive on interest rates and you think that they can go higher in yield, lower in price, there's such a big yield right now that you'll still get a positive return out of the bond market.
All right, so Jim, thank you so much. Jim Bianco there stays with us. We discuss tariffs in China after hearing more from our exclusive interview with the U.S. Treasury Secretary Janet Yellen. That's coming up shortly. Also, a good conversation on crypto. I'm looking forward to hearing Jim's thoughts on what the Trump administration can mean for crypto, for Bitcoin, but also blockchain. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. U.S. President-elect Donald Trump reportedly invites Chinese President Xi Jinping to his inauguration, despite fresh tariff threats against Beijing. Traders cement bets of a Fed cut next week after inflation rises in line with expectations. Plus, the ECB is set to cut rates for the 4th time this year, loosening constraints on the region's struggling economy, while the Swiss National Bank surprises with a half-point cut. Now, U.S. Treasury Secretary Janet Yellen has urged the next U.S. administration to maintain the dialogue channels that she reestablished with China. Well, she spoke exclusively to Bloomberg's David Gura on the eve of what's likely to be the latest round of economic and financial talks between senior officials from the two nations.
We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
Well, that was U.S. Treasury Secretary Janet Yellen speaking to us exclusively. Now, still with us, Jim Bianco, president of Bianco Research. Jim, thank you so much for sticking around. We're talking about inflation, Fed, some of the expectations that you see out there. So it's clear that, it's clear, you believe equities are priced to perfection. What do you do with gold?
Gold is an interesting one because it's having a great year, and a fun statistic for you. This is the first time ever that the S&P 500 and gold will be up 25% in the same year. Now, why is that? Because I think the market is signaling to us it's worried about too much monetary stimulus. No. That's got the gold guys going. It's got the stock guys excited that too much monetary stimulus means liquidity. So in this environment that the Fed is cutting rates and still talking about monetary stimulus, I think that the bid for gold will continue and it'll keep going.
But is it also a breakaway from dollars? So longer term, do you see a lot more central banks trying to challenge, I guess, the supremacy of the U.S. by buying not treasuries, not dollar?
Yeah, there's, especially the BRICS, they're going to continue to try and break away from the dollar. The problem is they're going to have a problem doing it because the rule of law, the deep capital markets, the derivative markets, the $5 trillion a day of dollars that trade, you can't replicate that with gold. You can't replicate that with anything else. You can't replicate that with a cryptocurrency. So, you know, it's our currency, your problem. The problem, it's been the old line about it. That's true, except, you know, the U.S. has got to not be reckless about having that privilege that they have.
I mean, crypto has been flying.
Yes.
Right? Since Trump got it or was elected. What happens to crypto?
Well, it's been flying because we finally got regulatory clarity. It has been a frustrating mess in the crypto space, you know, under the Biden administration, trying to understand where things are going to go.
Right.
Hopefully, the bull case for crypto, that it has moved higher, is now that we've got regulatory clarity, the innovation will be unleashed in that Bitcoin, Ethereum, they will become more than just stores of value, more than medium of exchange, that a whole new financial system could be built, you know, on alternative financial system could be built on these crypto rails. And now that they can start finally doing it, because it's just 2 years ago that they were jailing developers because they were building products that the regulators didn't like. So hopefully they can let that innovation go now.
Jim, I mean, Bitcoin, 100,000. What's the limit for Bitcoin at this point?
At this point, I don't think it's got much more on upside until you start to see other ideas come to play. That there's crypto rails that you could wind up seeing, that we could see it as a medium of exchange. We could see it as some kind of a use case to coming in. Now, maybe those use cases will come. It could continue to go higher from here. But for right now, it's really stalled out for the last month or so around this $100,000 level.
I mean, regulators had concerns about it being, you know, used for money laundering and dirty money. Do those concerns just disappear with the new administration?
No, I think those concerns are still there, but, you know, and let's accept that they're correct. It is used for dirty money and money laundering, but it's a small percentage of the world. It's still, the traditional financial system is the majority of the way that dirty money is moved. There are ways within the crypto system that they could find compromises if regulators want to work with the developers, and hopefully they will, and then they will find a happy medium.
Jim, I mean, between all of this fiscal spending possibly in the U.S., you know, the deficit is huge. How much more can the U.S. take of it? Well,
yeah, the deficit's 6.5% of GDP, and that has been typical of what you would see in a recession, but we're in the fifth year of a recovery. You know, since I'm here in London, I'll say, you know, we're waiting for the Liz Truss moment. We're waiting for the moment that the bond market says enough and that they put their foot down, and then it gets really hard to sell bonds. You know, it doesn't look like it's on the horizon immediately, but if we continue with these deficits at this level, there will be some point like that in the future.
It wasn't even talked about during the election campaign, which is for me, it was very surprising as an outsider.
It was for me, too. And in fact, even the few times it was ever brought up, people said, nobody cares. Well, you got a better question, is where they were with it right now. And part of the reason it wasn't talked about, because it seems like both candidates were into deficit spending. If Harris had won, it would have been spending. Trump won, it's tax cuts. So the deficit is going to stay. The hope is that the DOGE committee, headed by Iain and Vivek Ramaswamy, are going to produce these you know, efficiencies that will help to bring down the deficit. In theory, it's possible, but in reality, you know, call me skeptical.
Yeah. When you say like a Liz Truss moment, I mean, is this a big bond auction that just goes wrong because people don't want to buy it, or what does it look like?
I don't know if it's going to be that acute, you know, that you know, immediate event. But what it would be is interest rates keep going higher, and it becomes more and more expensive for the government to fund. Ultimately, what happened in the Liz Truss moment is when UK gilts went up enough, they broke part of the financial system, and liability-driven investing, LDI, broke. So if interest rates go up enough, the old adage is they go up and something breaks, then you say, why did it break? It's because rates are up. Well, what will get rates down? You've got to bring the deficit under control. That is more of an evolving kind of thing, as opposed to it's acute on one day that we can't get an auction done. But that still could be very disruptive, too.
Jim, when you look around the world, where else do you invest? If you're the UK, I mean, this depends quite a lot on the personal relationship that, you know, the prime minister of a country at a specific time has with Donald Trump. So is it impossible to park your money, as it were?
Well, the dilemma that global investors face is the story is well known in the U.S., and the story seems to be very positive in the U.S., and you're going to pay huge multiples and premiums to buy the U.S. The story's a little murkier in Europe, you know, Germany and France don't even really have governments at this point. But you're also getting a much better deal. You're getting those at much lower valuations. Yeah. And so I think that, you know, for the value investors of the world, they should probably be shifting away from the U.S. Europe looks like a very good value play right now. Sure, it might struggle a little bit in the future, but the growth momentum players will probably continue to stick with the U.S. But I kind of like the idea of the value play in places like Europe.
Okay, Jim, so good to have you on. Thank you so much for joining us. Jim Bianco, they're president of Bianco Research. Now, Adobe has given a disappointing annual sales outlook. This is one of the stories that we're watching out for. Full year revenue about $23.4 billion, just shy of average analyst estimates. The outlook also underscores worries that the software giant could be disrupted by emerging AI-based startups. Pre-market down 10%. Coming up, this is going to be fun. Award-winning chef Jason Atherton joins us to discuss his new restaurant and the future of the dining experience here in London. That's next, and this is Bloomberg. Welcome back, everyone. Now, Michelin-starred chef Jason Atherton has opened a new flagship restaurant on Savile Row, the famous home, of course, of British tailoring. Now, it's meant to be a symbol of his culinary ambitions, but also his love of sartorial craftsmanship in the UK. Now, he's opened restaurants all over the world, but says he wants this one, called Row on 5, to be his legacy. Now, let's discuss how he plans to do it and the challenges in the sector with Jason, who joins me now. A little bit mean, actually, putting good food at like 9:41 a.m. London time.
It's my menu, but I'm still looking at it going,
it's
pretty tasty.
Not bad. Jason, congratulations. I mean, it's never easy opening, like, you know, a big restaurant, an important restaurant. Why this restaurant and why on Savile Row?
Well, you know, Savile Row, but 295 years has never been an official restaurant on the row. I've always shopped there when I started to do okay for myself and could afford to shop on the row, so I started to be able to go down there, got to know a lot of the tailors really well, and then we got approached for a small space, an old tailor shop, which we could then convert into what we call a legacy restaurant. We really wanted to be a restaurant what would stand the test of time, what would go hand in hand with the row. We use Bennett and Witch leather for our menus, we use Cat and the Dandy for our uniforms for the front of house staff, we use just up the road there, our guy does all of the smoking jackets for people when they go outside, Daniel Henderson. So we really try to embody everything what's great about Savile Row. And I think, you know, the most proud thing for me, I think, when we can walk away one day and, you know, pass it on to the next generation, that Row on 5 will become, you know, it will go down hopefully it will go down as an iconic restaurant. You know,
it's difficult, I imagine, because restaurants, there's a lot of openings. I mean, you're one of the most celebrated and famous chefs, but yeah, I guess tastes are fickle, or popularity of restaurants are fickle. What's the secret sauce of doing a restaurant that lasts?
Do you know what? I mean, if there's no such thing as the secret sauce in our business. Some restaurants just catch the moment right. You know, we've opened 4 restaurants in the last 5 months. We opened a restaurant called Sale in Piccadilly Circus, which is going gangbusters. You know, it's really affordable, it's a beautiful space, you know, wine's under 50 quid, and the whole of London's just taking it to its heart. It's been well reviewed, and it's just going gangbusters. So there's, you know, although our industry has not been invested as much in the last few years, certainly I believe the future's bright for London. I think that we will continue to develop restaurants what will world class, and I think London will always be one of the best cities in the world to dine out. It's just, you know, navigating restaurants and guests' taste buds are really tricky, and you've got to live and breathe the restaurants.
Jason, because tastes are changing, because people go to restaurants and consume differently than they did pre-COVID or even...
Oh, you know, as you get older, and I'm 53 now, as you get older, you know, when we opened Pollen Street 14 years ago, Pollen Street was an instant success. It was absolutely so busy, and all of a sudden, you know, you 2 generations of customers have gone through your restaurants, and, you know, you start to see other restaurants opening up and what they're offering and stuff, and it's very easy to stay with something when it's a success story, unless it's iconic, like Berners Tavern, which is one of our iconic restaurants, which stays exactly the same and is fully booked every day, and that's you know, that's an iconic restaurant. But, you know, it's City Social here in the city also. That's pretty much stayed the same in 11 years. It's been fully booked. People love it here. It's our, you know, one of only 2 restaurants in the city with a Michelin star, and it's so we're very lucky.
Do people go out more but spend less?
exactly what's happening, Francine. So all the data, all the research we did, people were going out more today. I'm talking like the new generation of diner. They want to go out more. They want to spend less. So the restaurants what are adapting to that are the ones what are winning right now. And that's got to be the key. And the key is to have really good landlords. That's number one. The lesson number one. You have to work with your landlord. The landlord's got to be, if he doesn't favour what you're trying to do, then you'll never succeed. Because if you're going to get aggressive rent increases every 5 years, then the concept eventually will just fade out and fall over. You know, you've got to make sure you keep on top of staff costs. Staff costs are one of the biggest killers in our industry. You know, with Labour announcing that our minimum wage goes up again in April, although we're very adamant to pay our staff as much as we possibly can, as fair as we can. We also have to stay in business, right? And with spending going down and costs going up, there's got to be a point where the tipping balance doesn't work anymore. So you've got to really work hard. It's the classic 425s, right? So 25% food and beverage, 25% overheads, 25% staff costs. And in the good old days, it was 25% profit. Now those margins are squeezed down to like 11, 12% if you're lucky. So it's tough in our industry right now. But, you know, if you love it and you're passionate about it, guests feel that. And it's what I do. It's in my veins. I love cooking. I love making people happy. And that's what we do.
Is it easy to find staff, or is it much harder?
Much better. Post-COVID was horrendous, like
because
really
people stayed at
horrendous.
home, or did they just? Or
I just think it took a long time for the country to wake up, right? I think globally. I mean, we had a really successful restaurant in New York City called the Clock Tower, had 1 Michelin star, and we just couldn't get it working again after COVID. So we just had to shut it. It was, you know, there was a lot, you know, the pandemic, you know, killed a lot of our industry off, but we're a resilient bunch. You know, we all came back fighting, and I feel now London's as good as it's ever been. And we hope that, you know, Three Darlings in Chelsea, what we opened up just a month ago, 2 months ago, sorry, on Pavilion Road. What's
been your hardest moment? Like, is there a day where you kind of thought, actually, you know, I love what I do. It's like you live and breathe this, but is there a day where you kind of thought, actually, I'm not getting enough support from government, I'm not getting enough support from landlords?
I think the hardest moment was we were about 3 months into the pandemic, and we just got furlough, which you're also paying the tax and stuff, right? So we got furlough for the staff, which was the most important thing. Then me and my wife had enough, because she's my business partner as well as my life partner, we had enough money in the bank to last us 18 months. A lot of people fired their staff, laid them off, got rid of them, and let the government take care of them. We took the stance of, we're going to pay everybody, we're going to pay all of our staff till the money runs out, and just hope and pray that we've done the right thing. And I've got to say, 3-4 months in, you know, you've worked your whole life, right, from coming to London at the age of 16, washing pans, you know, learning to be a cook, with no desire to be a Michelin chef. That was never the plan. It was just to learn to cook, go back up north and open a little restaurant and support my family. That was the plan. Obviously, life had other things in store for me. And then you think, my God, I've worked tirelessly, 6 days a week, 18 hours a day. We've finally got success. We live in a nice home. Kids go to a lovely school. We've got some form of success, and it's all just been taken away. I mean, look, it's no one's fault. It was what it was, right? But it was a really hard pill to swallow. But, you know, after a couple of days of, you know, self-pity, people had it much tougher than me. People were passing away, not seeing their parents and all that type of stuff. So I just gave myself a kick up the bum and got back on the horse, and we came out the other side, and we survived, right?
But you're still, I mean, this year you're opening 5, but you had to also close 3 spots.
We closed a lot. I mean, at one point we were like 22 globally. Yeah. We're down to 12. I think it's probably enough.
Okay.
We have, you know, the plan is over time, row on 5 in London, which I'll spend predominantly of my time, and then row on 45 in Dubai, our 2 Michelin star restaurant, which got it in 6 months, which we're deeply honoured. I'll be splitting a lot of my time between Dubai and London, working on those 2 projects. We won't do too much more because I really want to cook.
Dubai seems like the happening place right now.
Yeah.
Right? Is it buzzier than London in the restaurant scene?
Yeah, I mean, it's hitting the point. I think it's going to hit saturation point. A lot of people go thinking the streets are paved with gold, a little bit like London was 10 years ago. And you've got to really work at it. I worked really hard, tirelessly, to be part of the local community, to get the customers to support us. I spent a lot of time in Dubai making sure that our cuisine, our service standards were on point. And it worked, you know, it worked. And I think that's the key to everything at the moment. If you give your guests a good time, great service standards, great food, they will come back.
Jason, thank you so much for joining us tonight. Congratulations on the new opening. Jason Atherton, their chef and restaurateur. Now, coming up, we talk sports and Saudi. Saudi's sports strategy pays off as the kingdom is officially announced as a host for the 2034 FIFA World Cup. So we're live in Riyadh with the reaction next, and this is Bloomberg. Well, Elon Musk has become the first person to reach $400 billion in net worth. Now, the most recent catalyst was an insider share sale of his privately held SpaceX, which boosted Musk's net worth by roughly $50 billion. Now, Tesla shares also rallied to an all-time high yesterday, pushing its chief executive's fortune to $447 billion. Also, South Korea's president is set to face another impeachment vote over his shock declaration of martial law last week. The opposition filed their second motion against Yoon Suk-yeol after he made a defiant speech earlier today in which he tried to justify his decision. Now, the vote appears more likely to succeed as the president loses support within his own party. And of course, Saudi Arabia will host the 2034 World Cup, marking the return of the world's biggest sporting spectacle to the Gulf region for the second time in 12 years. Now, the decision is being seen as a major victory for Crown Prince Mohammed bin Salman's push to improve the country's image and attract tourists. Now, for more, let's get straight to Bloomberg's Matthew Martin in Riyadh. Matthew, thank you for joining us. So how does the World Cup fit into Saudi Arabia's broader plans to diversify the economy, promote tourism and grow its soft power?
Hi, Francine. Yeah, look, I mean, as you say, the Saudis over the last 4 or 5 years have been on this huge push to start hosting these big global events, and the World Cup is really the pinnacle of this strategy. We've already got the Asian Cup coming here, Asian Winter Games. We've got the Expo 2030, and now we're going to have the 2034 FIFA World Cup, and it's all part of this plan of promoting tourism. They want to find all these events that are going to bring people into the country to try and convince them that Saudi Arabia is not the sort of country that you might have read about in the news, and they want to do that to bring in more foreign capital, more foreign tourist spending into this country, because for years there has just been money leaking out of the country because there's been more Saudi tourists going outside and spending money abroad than there have been foreigners coming in. And so this is all part of the push of trying to correct that, and also trying to boost this soft power projection of the country and change people's perceptions internationally of what Saudi Arabia is and what the sort of culture and society that Saudi Arabia stands for is.
All right, Matt, thank you so much. Bloomberg's Matthew Martin there in Riyadh. I know we'll talk about this for a very long time to come. Now, a reminder that we'll have live coverage of the ECB decision and news conference. That starts at 1:15 p.m. UK time. Then at 6:30 p.m., the European premiere of Bloomberg's latest episode of Chief Future Officer. Guy Johnson speaks to the Chief Financial Officer of the travel tech company Flix, which has become the leading long-distance bus operator in Europe and the U.S. And Bloomberg has also learned that the U.S. president-elect Donald Trump is scheduled to ring the opening bell at the New York Stock Exchange later today. Now, Trump has often tied the stock market's performance to his very own economic policies, so we'll have plenty more on that throughout the day. Up next, Bloomberg Brief with Manus Cranney in New York, and this is Bloomberg.